Cruisin' for a Bruisin' is a popular song from the 1980s and 1990s. The chorus goes like this: so don't stop the music. We ride fast like a bullet, we do anything we want, anytime we want, oh yeah? Oh yeah? Most might not see it this way, but target date funds exhibit this devil-may-care attitude at their target date, primarily because the risk is borne by investors, not fund companies. Beneficiaries ride fast like a bullet while fund companies get paid a premium for higher risk regardless of the outcome. Beneficiaries don't feel like bullets until they hit the wall of market crashes. Sure, TDFs are less aggressive at the target date than they are before that date, but they're still very aggressive, with one foot on the brake while the other stomps on the accelerator. The big three TDF providers, Vanguard, T. Rowe Price and Fidelity, do anything they want, anytime they want because they own the TDF market as an oligopoly with 63% of this $1.7 trillion treasure trove. Here's a graph of what they do. The big three are all about 55% in equities during the risk zone that spans the 5 years before and after retirement. This is actually riskier than the exposure in 2008 that lost 30%. The risk zone is important because account balances are at their highest and sequence of return risk starts when withdrawals begin. In the following we present 5 reasons that this 55% in equities in the risk zone is way too high, and should in fact be no more than 20%. Reason 1. Reasonable objectives. Fiduciaries should set the objectives for their TDFs, but this is not happening. Rather, fiduciaries are basing their TDF choice on limiting their liability. They believe that, 1. Any qualified default investment alternative (QDIA) will do, and 2. You can't go wrong with the big three because everyone else is using them. This is a breach of the duty of care. This duty requires that fiduciaries try to select the best on the basis of criteria that best serve the beneficiaries. That's simply not happening. So what objectives should fiduciaries establish? TDF providers say they've designed their products to replace pay and manage longevity risk, but these are mere hopes. Objectives without a reasonable chance of achievement are mere hopes. Saving enough is the only way to replace pay and manage longevity risk, and hoping that you can make up for inadequate savings with investment returns is not a prudent choice. The big three are 55% in equities in the risk zone because they have chosen growth over safety as a means to make up for inadequate savings. Their foot is mostly on the accelerator. In contrast, a reasonable objective is to get participant savings safely to the target date intact, and to earn a reasonable return on those savings. The Hippocratic Oath of TDFs should be, don't lose participant savings. There should be just one foot at the target date and it should be on the brakes. The Smart Target Date Fund Index is designed to achieve this objective, and looks much like Vanguard until it reaches the risk zone, at which time it moves to defend, reducing equity exposure to 10% at the target date, as shown in the next exhibit. Beyond the target date, the Smart Index re-risks, following the recommendations of Dr. Wade Pfau and Michael Kitces in their groundbreaking research entitled Reducing Retirement Risk with a Rising Equity Glide Path. Reason 2. Demographics. In its 2013 TDF tips, the DOL recommends that TDFs be selected to match workforce demographics. This has led to the growing popularity of custom TDFs, which are purported to tailor a glide path to participant demographics. But there is only one demographic that all TDF participants have in common: lack of financial sophistication. This demographic argues for the protection of the clueless. These folks need to be safe, especially in the risk zone. Like the big three, custom TDFs are generally not very safe in the risk zone, but they should be. Reason 3. Beneficiaries want to be protected in the risk zone. Beneficiaries want to be safe in the risk zone, and may think that they are, although they are not. A recent Mass Mutual retirement savings risk study examines beneficiary risk preferences in 401k plans. Methodology is as follows. On behalf of Mass Mutual, Greenwald. Respondents were drawn from Research Now's online panel. To qualify for the survey, all respondents had to be at least 40 years old. Pre-retirees were required to have a household income of at least $40,000, work full-time, for a private sector employer, and be participating in that employer's DC retirement plan. Retirees were required to have total investable assets of at least $100,000. They had to be retired from a private sector employer and participating in that employer's DC retirement plan at the time of retirement. One of the most informative tables in the report shows beneficiary preference for safety over growth in the risk zone. At 15 years to the target date, the vast majority, 75%, want growth over safety, but this preference shifts dramatically so that only 17% prefer growth over safety at retirement. Also shown in the graph, those with another source of income, like a DB plan, opt for somewhat more growth, obviously because their other assets are safe. The preferences in the table above can be used as proxies for preferred equity allocations along the glide path. The following graph shows these preferences in contrast to the big three and SMART. Beneficiary preferences are in line with Vanguard when participants are young, but they move to the SMART index near the target date. In retirement, beneficiary preferences are more conservative than all four paths. Reason 4. Consultants want to protect beneficiaries in the risk zone. This reason is somewhat problematic because consultants say they want to protect beneficiaries from harm in the risk zone, but they choose TDFs that do not afford this protection. A reasonable explanation is that consultants are choosing TDFs to protect themselves rather than beneficiaries, so they opt for the procedural prudence that the big three embodies. Pacific Investment Management Company, PIMCO, has conducted a consultant survey entitled the 2018 12th Annual DC Consulting Support. These firms advise over $4.4 trillion in USDC assets, accounting for almost 60% of all USDC assets. One of the questions that the survey addresses is loss avoidance at various dates along the TDF glide path. The responses are summarized in the next exhibit. Consultants want TDFs to defend against losses of 10% or more at the target date, and to become even more defensive beyond the target date, defending against losses of 5% or more. These goals argue for very conservative allocations, assuming that the objective is to have a low probability of the indicated loss. For example, a 10/90th stock bond mix has a 95% probability of protecting against a 5% loss in a year. Reason 5. There are 75 million baby boomers in the risk zone. This reason is a different flavor of demographics that goes beyond individual plan workforces to the entire population of the U.S., so this discussion includes IRAs as well as target date funds. The average IRA is 55% in equities regardless of age. Most boomers are currently taking more risk than they should because they are in the risk zone, a time when they should protect their lifetimes of savings. Of course, if boomers do sell a substantial part of their $30 trillion, it will cause a market correction, so you don't want to be the last one out the door. If they don't sell, the next meltdown, whenever it occurs, will create a public outcry like the world has never heard. It will take 20 years for boomers to pass through the risk zone, so there's a good chance of a correction in that time span. Conclusion: just because something is currently a certain way doesn't mean that it is the right way. If target date funds continue in the current way, beneficiaries are cruising for a Bruisin. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it. I have no business relationship with any company whose stock is mentioned in this article. Additional disclosure: I am a sub-advisor of the Smart TDF Index and the originator of the first and only robo-analyst that integrates age with risk. Please visit my blog at https://seekingalpha.com/author/ronald-sir/instablogs. Implementation of these models can be done for less than 6 basis points. Boomers are poised for a sucker punch that they'll never shake off.